McDonald's is a giant in the fast food world, with over 40,000 restaurants worldwide and more than 13,000 in the United States. They make over $23 billion in revenue each year, making them the biggest burger chain globally. Even though they faced challenges during the pandemic, like higher costs and supply problems, they still managed to increase profits. They raised prices for their food to make up for any losses. Right now, their stock is doing well, and higher menu prices mean customers are spending more. But it's surprising to see a company this big struggling. In this video, we'll explain why the largest fast food chain is facing bankruptcy in 2023. Before we continue, we'd like to ask for your support by giving this video a thumbs up, and be sure to subscribe to our channel so you can stay updated on our future content. Even though McDonald's is the biggest fast food company globally, did you know that 95% of its restaurants in America are run by independent owners? The tension between these independent owners and the corporate headquarters is growing this year. For a long time, these owners have been struggling with McDonald's strict rules and costly demands. Many of them are now at their breaking point. Some of the company's policies against these independent owners are causing harm from the inside. In April, McDonald's said they would increase their control over franchisees while avoiding joint employer responsibilities, which means they won't be legally responsible for what franchise owners do. "We want to be independent. If McDonald's doesn't want to be seen as our boss, they need to stop acting like one," said the National Owners Association, NOA, a group representing over 1,000 McDonald's operators in the U.S. The corporate changes included a new grading system, more frequent inspections, and a different way of granting 20-year franchise licenses, highlighting that these licenses are earned, not given yearly. Operators make around $100,000 to $150,000 per location. But when you consider they have to pay between $1 million to $2.2 million per location, it means they only make a 10% return on their investment each year. Instead of using that money to start their own restaurants, franchisees are mainly helping to grow one of the world's most famous brands. Now, many of them are realizing it might not be worth it. While corporate executives enjoy big bonuses and salary hikes, operators are being asked to cover the costs of expensive renovations like new furniture, decor, counters, exterior changes, digital kiosks, and better drive-through lanes. McDonald's decides what changes need to happen, but they only pay for half of the renovation costs. Since 2018, the company has spent nearly $6 billion on renovations, leaving another $6 billion for franchisees to foot the bill. If we divide that cost by their 14,000 stores across 50 U.S. states, it means that the average cost for an operator to renovate each store was a whopping $350,000. That's almost 70% of their store's earnings over the past 5 years. And during this time, many franchisees saw their sales and profits either drop or stay the same. But that's just the average cost. Some older locations that hadn't been updated in years faced bills of up to $1 million, and they had to pay at least $500,000 themselves. This put many of them in debt just to keep up with the company's new look. The locations that were considered outdated often had the weakest financial results and poorest performance. So the added costs have pushed many of these restaurants to the edge. Over the last 2 years, almost 28% of McDonald's franchisee-owned locations have changed owners. To compare, only 12% of franchisee-owned Burger King restaurants did the same during that time. What's even worse, since 2019, almost 34% of McDonald's restaurants have either been sold or closed down. According to operators, the company seems to be intentionally pressuring small franchisees to sell their stores to bigger corporate-owned franchisees, which are usually in a better financial position. A document released by the NOA claims that the chain is essentially forcing small operators to sell their stores to larger franchisees, who are typically better off financially. They either have to do what McDonald's says or risk facing bankruptcy and losing everything in court, according to the association. For around 40% of franchisees, McDonald's new financial requirements might lead to the end of their long-term leases because the company's rising expenses are making it hard for these stores to make enough profit. To put it simply, these franchisees could have their contracts canceled and lose all their investments if they don't meet corporate expectations. In simple terms, 1 out of every 4 McDonald's operators is in danger of going bankrupt because of the actions taken by the company itself. To show just how strained the relationship between McDonald's and its franchisees has become, a survey conducted by Kalinowski Equity Research asked operators to rate their relationship with McDonald's on a scale from 1 to 5. The average rating given by operators was just 1.19, making it the 3rd worst rating since 2018 when the remodeling plan began. It's only slightly better than September 2021 when the company faced issues with labor and supply chains and received an average rating of 1.18. In recent years, the fast food giant also imposed a new technology fee of $70 million on its operators. The National Owners Association, NOA, claims that this money, paid by franchisees, didn't actually lead to any technological improvements in the restaurants. Instead, it was used to pay off some of the company's debt. Many franchisees have taken legal action against McDonald's and asked for the fee to be removed, but the courts have consistently sided with the company. It seems like the fast food giant is prioritizing its shareholders above all else, even ahead of franchisees who manage their stores and the loyal customers who've come to appreciate its affordable prices over the years. But relying on operators to expand their business may not be a wise strategy. If enough of them decide to leave the company, it could put their entire business model at risk. While McDonald's is famous for its burgers, fries, drinks, and iconic symbols that have become part of American culture, what we eat from McDonald's isn't their primary product. Surprisingly, you and I aren't McDonald's real customers. This might be surprising, but a quote from the company's former CFO explains it well. "We're not really in the food business. We're in the real estate business." Harry J. Sonneborn highlighted, "The reason we sell inexpensive hamburgers is that they generate the most revenue, which our tenants use to pay us rent." In other words, the biggest customers of McDonald's are actually its operators. The company realized a long time ago that selling burgers wasn't hugely profitable. Even if they sell billions of burgers every year, making less than 15 cents profit on each burger doesn't add up to much on a company level. However, if you own the property where these burgers are sold, things change dramatically. Essentially, McDonald's lets operators use its brand so the company can make money from the substantial rent paid by these franchisees. This strategy has allowed the company to almost double its worldwide revenue since 1990. Today, McDonald's has the largest market value among all fast food chains, which is twice as big as Burger King's and over 20 times larger than Domino's. While this doesn't mean that McDonald's sells twice as many burgers as Burger King or that it's 20 times larger than Domino's, its business model focused on leases rather than sales is much more appealing to investors. However, this model has not been great for franchisees. For example, when the pandemic hit and the Federal Reserve lowered interest rates to nearly zero, real estate prices shot up across the country. Since McDonald's is essentially a real estate business, the company's total assets reached new highs. But this created a big problem for operators. At that time, they were struggling to pay their employees minimum wage while seeing a significant drop in customer visits. Yet, corporate was reporting some of its best results in years. When franchisees signed contracts with the mega chain, they were promised a partnership with the company. However, over the years, corporate changed the rules and regulations, making operators solely responsible for the risks of managing a low-profit restaurant business during tough economic times. In many ways, the pandemic showed these operators that the partnership between the franchise and its franchisees never truly existed, and for many struggling operators, this was the last straw. From 2021 until today, the number of lawsuits brought by franchisees against McDonald's policies has more than doubled. On the other hand, bankruptcies have also seen a significant increase, with the biggest one in 2023 happening in April, ending a 22-year lease, as reported by Restaurant Dive. Many operators are leaving after feeling undervalued by the company for years. On the customer side, things aren't going well either. McDonald's attempt to sell more expensive burgers hasn't been well received by customers. Even though menu prices have gone up by about 15% in the last year, fewer people are visiting McDonald's locations each month, and even fewer are returning multiple times in a month. In simple terms, customer loyalty is declining, and that loyalty has been a crucial part of McDonald's success since it was founded in 1955. Unfortunately, McDonald's is a clear example of how a successful business can deteriorate from within due to its own greed. As younger generations prioritize healthier foods, it's likely that in the near future, the fast food giant will start losing its appeal and eventually decline as fewer people are interested in becoming McDonald's franchisees. Today, if any of these operators had invested their money in the S&P 500 instead of McDonald's, they would likely be making much more profit. More people are realizing this reality, and it's contributing to the downfall of what was once America's greatest fast food chain.